Then on the characteristics of real estate, that's where, if you think about it logically, if you think about real estate, like every piece of real, not every single one, some of them are very, very similar, especially if you look at like a Baldwin property, but they tend to be very, very different. And obviously what makes each property different is the location. You always hear the real estate agents say location. So that's one of the things that makes it different. It's very high value if you take it as a single unit, and that's why it's nice to invest in a company like a REIT, because you can only buy a small portion, you don't have to worry about it buying 2 million rand house for management intensive. Think about this office block. Every single floor has got various properties that each one's got. You need to manage the efficiency, rental be there for I mean, all these things are quite management intensive, so these guys need to make sure that they've got everything in place. And there's usually a churn all the time. Some guys go bankrupt, maybe the lease expires, it's expensive, there's a nice new building across the road, same rent, all that type of stuff. And then the transaction cost is quite high. Just think about the friction cost when you buy a property. You have to pay broker's commission, you have to pay transfer duty, you have to pay registration duty, all these fees that basically causes the friction cost to be very, very high. One of the very nice things about properties is the depreciation. So if you go directly instead of through a REIT, then obviously there's a lot of tax deductions. And that's why high net worth individuals, when you guys get to level 3, it's gonna be one of the answers to probably one of the questions. But the reason why a high net worth individual would rather go direct into property investment instead of through a REIT is because they have all these tax deductions that they can go. And that's quite nice if the government funds your wealth creation journey. Okay, debt capital, nice, you can lever it up, and that's self-explanatory. To buy a house, you can get like a 90% loan sometimes. Very liquid. Takes, I think the last stat I saw was it takes about 14 weeks for a house to sell on the market. So that's, once again, that's residential, that's not necessarily commercial. Commercial tends to be much longer depending on where it is. Just imagine Liberty 2 Degrees, that's the guys that own this property. Imagine they want to sell this, like they want to sell Sandton City. And there's only like literally a few guys that can buy. It will take them a very long time to get maybe the price they want. And then price determination, there's a very specific way that you need to value it because it's going to determine on the net operating income. And we're going to go through an example like that pretty soon. Okay, so the classifications, residential, you know, non-residential is everything else. I mean, just think about, once again, office, retail, you've got logistics. And then you see all these big boxes where, like at ShopRite, well, they own their own DC, but you see that DC that they have close to the Mint. I mean, that is a big property that, if you think about it, is at the perfect location, close to highways. So each property, like for example, the logistics one, needs certain characteristics for it to be valued highly. And then other examples, we don't really have this too much in South Africa. That's more of a US type of thing. Timberland and farmland, and obviously when you buy it, it's to do with the fact that they're harvesting the agricultural product on, or the biological product on the land, and that's how you get your revenues. No, it is. It's a subcategory. I think there's specific tax stuff for potentially, but it has the same characteristics. But then again, once you harvest it, it's done. Then you can't generate a lot more money off of it. It might be a unique thing, but I tend to classify it as very similar. Okay, guys, and then the benefits of equity real estate. Okay, so think about when you buy whatever Texton, Hyperop, whatever it is. The nice thing about when you buy that, you've got a yield that you're getting from. So you're holding this instrument, and it's giving you 10%, 5, 10. Some of these guys are giving you 15% yield every single year. That's quite a high yield for investment. So that's the current income benefit about it. So especially if you're a person that's, whether it's an institution like a pension fund, or maybe let's say you're a bit more advanced in your age and you're going to retire, you tend to need some yield from your assets because you need to live off of it. Okay, so that's why you tend to gravitate more to these type of real estate investment trusts because you need to live off of the income. Capital appreciation, it depends on which property it is and how the management basically invests the additional money. But the nice thing about that is there tends to be capital appreciation due to the fact that there's inflation attached to these things. So if inflation is high, there's a tendency for the rental agreements to have an inflation clause in it. And then as it goes up, obviously the capital also goes up, which is quite nice about the next one, which is the inflation hedge. So as your rental goes up, maybe the node expands, and then obviously the rental keeps on going up and up and up. Okay, if there's an oversupply, it's a slightly different story. But the main thing is that if you think about property in, I don't know, like Hong Kong or certain other places, as there's more urbanization that comes into play, people utilize the properties more, then usually that price is going to go up. The diversification one is also quite nice because the tendency for real estate is not, I mean, the correlation between that and equity and bonds are not one. And that's the main reason why you tend to invest in alternatives. And you guys would have read that in the level 1 anyway. The reason why you look at alternatives because the correlation, and you guys have gone through the portfolio management stuff. Well, I think I'm going to go through it on Sunday. But it's, you know, that whole thing about the volatility and the correlation, etc., etc. So diversification one is quite nice. And tax benefit I mentioned before. Then the risks. I mean, these things are, I'm just going to touch on it very briefly because there's no use me reading this stuff. But business conditions, GDP not very high, obviously less demand for whatever property, for most properties. Long lead time, just think about when they start building something and ending it takes about 1 to 3, maybe in 5 years. Cost and availability of capital. If the markets are very frothy, people just want to get the money away, the yields are low, they want to get more money somewhere, then they would give the capital to a variety of guys that can give them that, and that tends to be the real estate guys. Unexpected inflation, demographics, lack of liquidity. Guys, I think all this stuff is quite self-explanatory. If you guys want me to stop anything, just okay. Anything's happening. Okay, the role of that, once again, it's got characteristics of both a bond and equity. Bond because it's got a fixed coupon type of distribution, and with equity, obviously, it's got a capital appreciation. So that's the nice thing about this type of investment. And then at the end of the rental term, there is uncertainty surrounding the renewal and future rates. Okay, future rates, interest rates. If interest rates go down, the value of the property tends to go up. Why? Because when you value the cash flows from your rental stream, if you have a lower cap rate, then it tends to shoot up the property. Okay, that's fine. Okay, then describe commercial property types, including their distinctive investment characteristics. Okay, guys, this is, once again, I'm just going to touch on it. You guys can read this at home. Office, what drives office? It's going to be the business cycle, the GDP growth. If there's a lot of confidence in the market, there's a lot of growth in the economy, then what tends to happen is firms tend to hire, and to hire people, not everyone can sit at home and work from home, so obviously they need offices, and that's where the demand for the office comes from. Okay, industrial's got a lot to do with, once again, the economy. So there's a lot of industrial, like the retail space that you need for, so the shopping centers are good, and they've got shops in there. Obviously, each one of those guys have got distribution centers that need to go out. It's all to do with the economy, essentially. Okay, because you're going to need more space as you create new companies and expand your current operation. Retail has a lot to do with consumer spending. So obviously, GDP growth again, like everything's, and job growth and all that stuff. And then multifamily, that's more to do with the residential side. Okay. Okay, that's fine. Okay, then we come to the highest use and best use. Okay, so they're probably going to give you a thing in the exam where they say, this guy owns a piece of land, he wants to get the best use out of it, so either he can develop it, get a developer, he needs to pay the developer this much, it's going to cost this much, developer margin is this much, and he can sell it for this, or he can do something completely different, like just make it a caravan park and get whatever for it. So the main thing around that is that you want to impute the land value from that calculation. And after you've done that, you get to the highest value, and that's the option that you go for. Okay, does that make sense? Okay. Then residential, real estate valuation. Guys, this is almost exactly like equity. Okay. It's a slightly different way that you're going to calculate it, but it comes down to the same type of approach. So the cost approach is very similar to an NAV type of calculation, and it comes down to the fact like how much will it cost you to replicate the same property on that stand or on that piece of land. And how they're gonna give you like a bunch of examples. We're gonna go through one. So that's the cost approach, and you're obviously going to deduct wear and tear and if there's an impairment or anything like that, but that's the cost approach. So that's kind of replacement payment. Okay. Then the comparative sales approach, easiest one that I can think about that I'm hoping you guys are going to do this once you buy a property, is if you're buying a residential property and it's in a complex, okay, you can draw a report from whether it's limestone, I don't know I know Property 24 also does this. You can draw a report and you can see how much the other units in the complex have sold for the most recent sales. And then what you're going to do, you're going to say, okay, per square meter, this is how much it's going for, and you're going to see roughly where the asking price is, and you're going to go for a similar price. That's the comparative sales approach. So that's the same as doing PE multiples and price to book and that type of stuff. And then the income approach is like your normal DCFs. The difference between real estate income, this approach, and maybe a DCF that you're going to do with equity, is that you're going to use the net operating income, and that's an unencumbered cash flow. When I say unencumbered, it doesn't have taxes in there, and it doesn't have interest expense in there, because you're working out if it's fully equity funded. That's the big difference between this and something like a discounted cash flow. Okay, let's go through an example. Okay, a property that was developed 5 years ago cost 10 million, including land. It's put on the market for that. Okay, guys, this is an easy one. Okay, you guys can read through that. This is not a difficult one. It just basically says the property sold too quickly, they could have gotten more for it, so the market values slightly high. Income approach. Okay, once again, similar to the DCF. So the direct capitalization approach. The cap rate on, and I want you guys to remember this. The Gordon growth model, and I'm sure you guys know the Gordon growth model because you would have done it in level 1. The Gordon growth model is D1 divided by R minus G. D1 is next year's dividend divided by R minus G. We're going to go through this in equity this afternoon, but I just want to highlight this. This R minus G, your required rate minus your growth. Another way to look at this is that's a cap rate. Okay, we use a cap rate because that's what we use, the terminology we use in real estate, but it's the same thing. R minus G. So when you hear cap rate, you know that it's required rate minus your growth. Okay, just wanted to highlight that. Okay. Net operating income. The first step when using direct capitalization rate is to calculate the net operating income, defined as blah 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 blah. Okay. Important thing around this. That is not taxes. It's not your normal company tax. It's your property tax. It relates directly to your property. As you go through this, your gross rental plus what other income you've got, less vacancy losses, less collection costs or losses, less operating expenses. Once again, insurance, maintenance, repairs. You do not have company tax or income tax in there, and you do not have interest expense in there. That is hell of important. You have to remember that for the exam, because when they ask you the question exam, they love to put something in the question that says this is the interest, or this is the tax rate, this is the interest expense, etc., etc. You have to remember this number does not include, you haven't deducted interest expense from that, which is correct, and you haven't deducted income tax from it. Okay. So the capitalization rate, what you're going to use 1 year's forward net operating income, and you're going to divide that by your cap rate. So almost exactly the same as the Gordon growth model. So it's a cash flow, which is the net operating income, or a proxy for cash flow, divided by R minus G, which is your cap rate. And how they would say, and you actually have cap rates for a variety of properties within South Africa, and they tell you what the cap rates are if you go to firms like JLL, or there's a few of these property consultants. Okay. We divide rent by a comparable sales price, we arrive at the all risk yield. Okay, see formula 97. Okay, we're going to go through that later. Okay. The thing about the all risk yield is that when it's called a wet lease. So in other words, it's when you rent out a place and the guy is in charge of the tenant is in charge of the operating expenses. That's the all risk yield, and that tends to be higher than if you take care of the landlord. Okay. Stabilized NOI, that's just a different example. That's just a different word for saying that you've normalized it. And then the gross income multiplier, it's the same as a multiple, guys. You just take what the multiple is for the property and you multiply it by the gross income of the property. The issue with this type of stuff is that it doesn't take into account unique nuances with regards to the property, whether it's more maintenance or capex that you need to spend to keep it correct or to keep it up to scratch for people to actually stay there or to rent it from them. Okay, the discounted cash flow approach, once again, very similar to the one we just did, but remember the one we just did is basically like a terminal value that you get. So it's a once-off thing. So when using the discounted cash flow approach, we estimate cash flows for a certain holding period and then estimate the terminal value at the end. So the terminal value at the end, what are you going to do? You're going to work out the NOI divided by the cap rate, and then you discount that value back. So just on a timeline, NOI 1, NOI 2, NOI 3. You're going to work out the terminal value here, which is going to give you the terminal value at that point, and you're going to have the cash flows of these two that you're also going to discount back by the appropriate discount. Okay, we're going to go through an example, so don't worry. Okay, then valuation using different lease structures, the revision approach and the layered approach. The revision approach essentially is that, okay, so you're renting out this property or you're leasing out this property and the guy that you rented it out to is tied in for 5 years and there's a certain escalation. After the lease expires, the surrounding properties or properties with the same risks and the same, that similar properties might be leasing for a lot less. Maybe there's a 20% lower than what it is at that point. Then it's going to revert back to, it's got negative reversion. Okay. And that's the same for something that if the tenant signed a very good deal and all of a sudden it's a very desirable location and then as soon as it goes out of that rental it can actually shoot up 20%, then it's the same. So how do you do that? You're just going to basically discount back to 5 years, and then in the 5th year it's going to revert up or down, and then you're going to exit it on that rate. So that's basically what it means with the revision. And you're going to adjust the rates for that. So the revision is going to have a different rate to the one that's in force. Okay, the in force might be a little bit lower discount rate or cap rate due to the fact that, you've got the guy in place, where the revision might be a little bit different because it might be a little bit higher due to the fact that you still need to get 10. Okay. The layered approach is similar in the sense that all that you're doing is you're basically going to see what it is now, what it could rent for now, and then either you're going to adjust up or down the one that's in force, and that's essentially for that time period, and that's essentially what it does. I think we are going to go through an example. Okay, discounted cash flow assumptions, projected income from current lease, start and end of lease must be tracked, keeping in mind, right, you can read through this. Lease renewal assumptions. It should just give a very similar approach. Yeah. Yeah, that is perpetual, yeah. No, it should give the same range. Because if you've got a perpetual and the one that's in force is going to be high or low, so it's actually going to come to the same. It should come to the same one. I'm pretty sure it should come to the same value if you use the same assumptions. Okay. Any other questions, huh? Okay. Operating expense assumptions, guys. Once again, if it's fixed, if there's more tenants, it goes up or down and so on. Capital expenditure assumptions, what you're going to have to repair there. Discount rates, obviously that moves as inflation goes up and down, or not inflation, interest rates go up and down. Vacancy assumption and estimated resale price. Guys, if your vacancy starts to increase, obviously the value of the property just keeps on dropping. So you want to make sure that that's as low as possible, and that's a lot of the time, although that might be to do with the fact that where the property is located, it's also got a lot to do with the management team you have in place. Sometimes they don't manage that stuff effectively. Okay. Just as stocks, the greater earnings potential tend to be the higher price earnings multiple. Okay, that's basic. Okay. So I want to highlight here cap rate, NOI, 1 year out, divided by the valuation, or alternatively, if you want to divide valuation, then obviously it's just NOI divided by the cap rate. Here's your all risk yield, so rental, not necessarily your NOI, and then gross income multiplier, the same as what you would do with multiples and equity. Okay. Just aware of the time. Okay, so a property is currently being renovated. The expected return on a renovated property would be 13%. Due to the renovation, the net operating income will only be 5 million for next year, after which it is expected to be 10 million with an expected increase of 3% per year. What is the value of the property closest? So let's just draw the timeline. So you're going to get over this period 5 million. From here onwards, you're going to get 10 million. That is growing by 3% per annum. Okay, but the thing that they do say here, and that's important, is that after which it's expected to be 10 million with an expected increase of 3 million per annum. Okay, so what are you going to do? You can do one of two ways that you can do this. You can either say, okay, I'm going to discount this back 1 year, 5 million 1 year, by the appropriate discount rate, which in this case is 13%. Or, well, that's one way. And then you're obviously going to exit this 10 million with the appropriate growth and all that stuff. Or alternatively, what you can do, you can just do this, exit the 10 million from day one, and you can deduct the 5 million present value. It's going to come to the same answer. Okay, so how did they do it here? Let's see. So they said value of renovation is equal to 10 million divided by... Okay, so they exited immediately. So as of day one, this is how much it's 100 million. But because of the renovation, there's a loss of 5 million during the first year. If for simplicity we assume that this would have been received at the end of the year, blah 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 blah. So all that you did there, you said, okay, I'm exiting day one. This property can earn 10 million a year once renovated, obviously, but it's not earning that this year. It's going to earn that only next year. So we take the 5 million that it is earning less, because 10 million minus 5 is 5 million. We're going to present value that by the 13%, and we deduct that from the 100 million. And that's how we get the value of the property. Because remember, you're not getting that 10 million in the first year, the cash flow. Okay. And that's how they got that. Yeah. So it's what a similar property sold for. Okay. Okay, that's not. Okay. Then they give you the pros and cons of the different methods. Guys, you can read through this. I don't think this is super complicated. Okay. Which of the following is similar between the... Okay, you don't need to do that. Okay, then the cost approach. So the cost approach, based on the idea that investors should not pay more for a property than it would cost to build at today's prices, take into account all the various stuff, and obviously also you need to take into account the depreciation and the almost like the impairments to a certain extent of the earning of this building. So let's just go through this example because I think this is quite an important one. So first of all, they give you the size of the property, 4,000 feet. They've got 35 years left, so 50-year life, 15 is done. Building needs new windows at 10 million, and it'll add 3 million. That's also called an incurable improvement. What does incurable mean? Incurable means that if you spend more than you are going to get out on a property with a capital improvement, that's incurable. If you're spending 10 million and you're going to get 20 million of value, that means it's curable. Okay, so that's just a technical term they use in the exam. Poor design, annual rentals of 500,000 less than a comparable property. Guys, that's a per annum. So you need to take that 500,000 and you need to basically exit the exit value. The correct way to have done that would have been over the 35 years, but I mean for simplistic sake, what we're going to do, we're going to take that into perpetuity. Okay, so it's going to be 500,000 divided by whatever the cap rate is, which is 10% in this case. And you're going to deduct that from the value that you're determining. Okay. Upmarket area in which the building is located has recently been hit by a natural disaster. Okay, once again, same thing. 700,000, you're going to exit that value and you deduct that from the value of the property because it's into perpetuity essentially. Okay, increased number of properties in the area has increased vacancy rates and resulted in this much loss. That's a once-off. Okay, the cost to repair the building is $500 per square foot. Okay, now we're getting to the thing. Market value of the land is 30 million. The developer plans to make 10 million. That's a cap rate. So first of all, how much it costs to develop this thing. You need to add the value of the land and the value of the land technically is still going to be there whether you build the property or not. But to build this thing, it's going to cost you $500 times the 40,000 square foot times plus this guy's development thing. Okay, and you're also going to deduct the windows because the windows you need to improve anyway. Otherwise, the guys are not going to rent this thing. Okay, so that's where this is. That's the development margin. There's the windows. Get to that. Then you have the value of the land because that's part and parcel of the entire property. Then you're going to start. You're going to say, okay, what's the deterioration? What is what interest are you going to get less and all that type of stuff. So first of all, the physical deterioration. So that's your depreciation. They gave you this 15 years out of 50. Okay, so straight line. Gives you that. That's quite self-explanatory. Functional obsolescence and locational obsolescence. Guys, to me, that's basically part and parcel of the same thing. And you're going to exit that basically at the cap rate. And the reason you do that is because into perpetuity you're going to get less rental because of that specific criteria. Okay. Deduct those two, and then the last one, economic obsolescence, and they gave that to you. That's a once-off of the 6 million. And then you can get to that. So that's kind of the estimated value of the property, the cost value. So you just basically look, all that you're going to do that you need to remember is that it's either a once-off or you need to divide that by the cap rate. Okay, it depends on if it's per annum or it's once. Okay, I would say that's a more complicated between the two. Then the comparative sales, once again, those PE ratios type of stuff. So those are the sizes, and they give you like the difference between the two. One's old, one's new. Location might be better, condition, etc., etc. So what you're going to do, you're going to use your own property as a reference. So if your property and the property you're comparing to is the same, then there's no adjustment. If your property is better than the other property, you need to increase the value for that specific element for that other property. You keep your property the same because yours is the yours is the comparable. And then, okay, they give you the adjustments, plug and play. You work out the average and you impute the value for that. So, guys, I'm not going to go through this because we've got to rush now. But you get to, once you've done all the adjustments, up or down, depending on what it is, using your property as a reference, you're going to work out the price per square foot. You're going to work out the average. Maybe they give you 3 properties for an exam. They're probably only going to give you 2 because you don't have too much time. And then, obviously, once you've done that, you're going to impute that value per square foot on your property, and then you get a value for your property. Is there any questions on that? Yeah. It'll probably be a combination of it. If you're working for a property firm, you're going to do all of this. I mean, because it doesn't take that long. If you're the buyer, you're going to take the lowest value. If you're the seller, you're going to want to use the highest value. But it's probably going to depend on what the standard is for that market. So for an industrial firm, or for an industrial property, they'll probably look at, it'll be a variety, like how much they can get. So it'll be the cap rate and what the cap rates are, and that's what all the guys talk about. But if they need to improve the property for that, then they will adjust it down. So it'll be a bit of a combination. That's it. In the market, that's definitely how they do. That's a variety. You would. Yeah. So if you're going to buy the property, then you would. If you're going to value the property, then you're going to see what the cash flows are. Sorry, yeah, yeah. They can't expect you to guess. Yeah, they'll definitely give it to you. No, you have, guys. This stuff to do this, you need a proper database, huh? Like you've been in the market for 20 years, and it's like, yeah, yeah. You're not gonna go to property. Oh, okay. You need a guy that's been in the market for 20 years, that's gone through whatever transactions, and you need someone with knowledge to do that. So, okay, that's why it's an alternative asset class, because guys spent their entire life just on it. Okay. Just ask again, so I have nothing. Because you're not a developer, gonna have to pay that anyway. It's gonna go to whichever developer, because the developer needs a margin. So because you're not a developer, someone else is. So you're a property company and you want to replace this. So then you go to a developer like WBHO or whoever, and they're going to give you, to do this. This is the cost of the material, and this is what I want. Okay. The guy with his bucky and his whatever guys. Okay. Guys, you can go through that. That's fine. I need to go through this one. Okay. Then the due diligence. Guys can read through this. I think the more important thing about this specifically is you want to make sure that the leases are in place, how does the reversion work, and the main thing is the interest rate. The interest rate is like a really big thing when it comes to property, and it depends on what they lend at, how, if it's fixed or floating. So a lot of times when you look at REITs, they talk about the LTV. LTV is loan to value. If it's all fixed, it's great, especially if the interest rates go up and it's a fixed interest rate. This guy was very good at managing the interest rate exposure, but it tends to be a blend of the two. Okay. Anything else? Okay, just go through, but you're just gonna make sure that you do a proper due diligence, like an audit on the stuff, and you guys can read through what it means to do the audit. Okay. Just one thing as well is that you can buy a property and you can have all these plans for it, but if you don't have the zoning rights, that's a big disaster. Okay, so that's also quite important. So you need the right legal team behind them, and who's helping them with that. Have they been able to take it through that type of stuff? So those type of things are quite fundamental. Then the appraisal-based indices. I think appraisal-based indices is like the problem with that. I think that's more important probably if they ask you that in exams. The problem with an appraisal-based index is that it tends to be smooth. It's smooth, then obviously the volatility goes down. If the volatility goes down, sharp ratios go up. Sharp ratios goes up, your risk-adjusted return goes up. Okay. So that's one of the negative things about an appraisal-based index. Okay. But this is what they do. They say net income minus capex plus changes in market value divided by the beginning multiple. So as I said, tends to smooth the index, volatility reduced. Not exactly the best way to do it, but the problem is you don't have many other ways to do it. Then transaction-based indices, you have two: the repeat sales index and the hedonic index. The problem with the repeat sales index is that there's a sample bias built into the index, because you can only include a property that's been sold more than once. And the tendency is that the same properties tend to sell often. I mean, I don't know how many times this office or this building has been sold. Like, I don't think that it was ever sold, to be honest, because it was built by Liberty and it went into Liberty 2 degrees. So that's an example of something that cannot be in the repeat sales index, although it's a specific property that's quite big in the retail space. And then the hedonic one is it only needs to be sold once, and then obviously you apply stats to that, and then you go from there. Just know that the repeat sales index has got a sample bias to it. Okay, I can go through that. I can always very determine the determinants and the risk and stuff, GDP, interest rates, all that stuff. You should kind of know that. That's not it. Okay. Then the debt service coverage ratio. When you look at a property, what's important is that you need to generate more cash flow than obviously the debt service, because if that's not the case, then obviously it will be a distressed property. as in from a financing perspective, so the balance sheet share, not necessarily the property itself. So once again, your net operating income in the first year divided by your debt service. What is your debt service? It's your principal, so your capital repayment and your interest cost. Okay, so that's the first thing you have to know. The second thing you have to know is the loan to value. So what is the loan to value? It's the principal loan outstanding on the property or on whatever company or so on, divided by the value of the property. So that's your loan to value. So if you're a private individual, you're buying a property, I don't know what the LTVs now is for the banks, but let's say you're buying a property of 2 million rands or 1.5. The bank might, if you're first time buyer, what the bank might do is they say, you know what, we can see your cash flows are good and everything, we'll give you a 90% LTV. What does that mean? You only need to put down 10% deposit, and all the transaction costs and stuff is obviously also bought by you. So that's the LTV. Okay, the LTV, it's important for the bank to have as much collateral as possible, because they want to make sure that if you default, that they can protect their collateral and they don't lose cash. The problem with that is if you're an investor, you want to lever up as much as possible because you don't want to use your cash, you want to use the bank's cash. So that's a typical private equity model. Okay, and the equity dividend is basically just what's left for the equity guy or the equity investor at the end, divided by his investment. So obviously the leverage effect will increase that if you're earning more than obviously the debt cost as a percentage for the entire thing. Well, the main thing is that you don't necessarily always need to do the capital expenditure. You can make the property go into obsolescence over time if need be. That's kind of I think that's maybe one of the reasons why they do that. Okay. Let's check this quick. Well, guys, this is just basically like how to work out the dividend. I don't think that's not too difficult. Okay, that is. Any questions on that segment? Okay, let's go to the second one. Okay. I'm going to try and rush through this quite quickly. We are definitely behind. Okay, so I'm going to go very quickly. Guys, you know what REITs are? REITs are the stuff that's listed on the stock exchange, pass through, so the tax benefit. So the REIT is not taxed, the end investor is taxed because that's rental income. This company is taxed, it's very similar to a REIT. And then you guys went through the mortgage debt securities with Mo, so I don't want to hamper on that stuff. So all the advantages and disadvantages, I kind of think I touched on a lot of these things. So direct ownership versus taxes. Obviously, if you're a high-net-worth individual, you get the tax break. Increased liquidity for REITs because of the fact that you can just sell your shares, and you don't need to buy a 3 million rand property. You can just buy 20,000 rand worth of shares and hide profits at all these various big malls around the country. Okay, reduced minimum investment, just said that. Limited liability, obviously you can only lose the money that you put in because you're an equity investor. The cost structure tends to be a lot lower for a REIT because you have professional management, and for you to manage maybe 5 properties, it's going to take you a lot more time. It's quite expensive. It's more of a time thing than anything else is. So that's a nice thing about the cost structure. Stock market forces has a big impact on your REIT, so the correlation is quite high. And once again, if you have a big REIT, like you look at something like Fortress. Fortress is a logistics property REIT, and I think they've got like 60 people that work for them, and it's a few billion rand property REIT. And that's quite interesting because you only need 60 people to manage all these properties. So that's why, and you've got professional management, so that's why the cost structure tends to be lower. You can buy premium properties. Conflict of interest, upreat and downreat. Let's ask this actually at the previous, when I went through this segment. The important thing about that is, an upreat is what happens is the guy owns a property, and if he puts it into a REIT, then he can get shares in the REIT. So there's a way that there's a conflict of interest, that you either overvalue or undervalue that property, and then the guy gets less or more shares. So there is a conflict of interest when it comes to that. Okay, we've gone through that. Limited income growth. If you pay out all your income and you don't reinvest in it, obviously think about the sustainable growth rate. That ROE times retention ratio. That basically tells you that if they pay out all the income and they don't grow their asset base, then obviously the growth is going to be quite limited. Okay, and then diversification benefit, I mean, you don't have just one property, a variety of it. And then of course equity issuance, obviously that LTV ratio is very important. So you want to make sure that it doesn't blow out, or I mean, obviously the value, maybe the value of the properties goes down. If the equity value also goes down, then there's a certain ratio the banks want to have, as well as the REITs, and then they need to either do an equity issuance. It's the same with the rights issue of companies that are going through very difficult times. Like someone like a Tongaat and so on, they're probably going to have to do a rights issue. Advantages, disadvantages, guys, you can go through this. I think we've touched on the tax and predictable earnings and yield. Yield, you get income. Predictable earnings, there's rental stuff in place. The leases are in place, so you know what you're going to get. Okay, that's not a difficult one. We've gone through the drivers: job growth, new space, population. I don't think that's difficult. Income tax exempt. It's high yield because they need to pay out everything. It's part of the REIT Act. Like, you have to pay out at least 75%. That's like, it's part of the. If you want to be a REIT, that's part of the rules of the game. Okay, low income volatility. You know, the price volatility might be high, so what the share price might go up and down quite a lot, but you know you're going to get your income. Okay. And then secondary equity issuance. As the REIT wants to grow, they come to the market all the time. So they've got an opportunity to buy these properties. Then it's called, they're going to tap the market and they do a accelerated book build. So that's a secondary market offerings. Risks. Once again, you guys can go through that. Due diligence, we've gone through that as well. That's not a difficult question. And then all the variety of REITs. We don't have all these things in South Africa, unfortunately. But each one of these, and the one I really like is this one, the healthcare REIT. Okay, that's one that we don't really have in South Africa. We also don't really have we don't really have a residential REIT. We have one or two. But like Baldwin Properties, I don't know if you guys know that property or that company. They're actually in the process of trying to build a residential REIT of the properties that they are building. Okay. One thing I do want to highlight out of all this stuff is when you look at the retail REITs, what tends to happen in retail, like the one downstairs, you have anchor tenants that like ShopRite and those guys, and they would tend to pay a certain amount per square meter, which is quite low, and then they pay a percentage of turnover over a certain turnover. So let's say the turnover roughly is per month at the ShopRite downstairs is 100 million. I'm just guessing, I don't know. Let's say 100 million, and then they say, okay, listen, you're going to pay us 50 rand per square meter that you have from us, but anything above 80 million rands per month, you're going to pay us 1% of that, or 50 basis points or something like that. So that's how these retail shopping centers tend to get their income from. So in very good times, they print money. In bad times, they've got the floor that they're going to get. And then the hotel REITs, what tends to happen is the guy that owns the property that the hotel is in and the hotel manager is two different companies. So you have the guy that owns the property, he gets his whatever, he gets his income, but then there's that person that's renting this REIT might say, okay, I want 4 seasons to operate, and they sign an operating agreement with that hotel group, and then that hotel group comes in and then they also share in it, and that they ask a management fee for that, like 2% of the property value. Okay, that's how hotel REIT tends to work. The rest of the stuff you can read through. I don't think that's particularly difficult. Okay, that's fine. Okay, I need to start getting more. Net asset value per share. Guys, I think that's a very easy calculation. It comes down to one thing. You need to make sure that you work out what the value of the thing is, the market value of the assets. Take off the liabilities, divide by the number of shares. So it's exactly just an NAV calculation. I don't think that's particularly difficult. And you can calculate the value of the thing by the cap rate. Sorry guys, I'm just very aware of how late it is, so we need to make plan. Okay, so FFO. There's two calculations you're probably going to have to do in the exams. It's FFO and AFO. FFO is so funds from operations. So it measures the continuing income of a REIT. So it's your net income, add back depreciation, add back deferred tax, add back losses from sale of property and all this other stuff, less gains from the sale of property and debt restructuring. So you're taking off all you're adding back to like a lot of the non-cash stuff, and you're essentially what you're doing is you're working out what almost like it's not exactly the free cash flow, it's a free cash flow like the CFO, the cash flow from operations. That's what you're basically working on. Yeah. Well, it's either deferred tax expense or income. It'll be both. So it's not just it's probably that's probably wrong. Expense or income. Deferred. Yeah. Because there's an adjustment that you make in the tax note. No, the deferred part. So because they don't take the accounting, they adjust the accounting one with the deferred.
So they want us to add. I'm saying by adding back the deferred tax, they are allowed only to deduct the income tax, the accounting tax.
But they got the current tax, yeah. Yeah.
They want the extra.
Don't make it too complicated, guys. This is if they give you this and they give you the thing, then you add or subtract. Don't make it. Yeah, you would subtract. Yeah, so it's expense or income. It's this is a. Yeah, you would add the income and. No, you subtract the income and subtract the income and add back the expense. Okay, guys, we've got to go. Okay, adjusted funds from operations. That's more like your free cash flow to the firm. Okay, so the difference between the two, the one is your CFO, and the other one is like your free cash flow to the firm. So the big difference between this and this is that you take off non-cash rental and you take off the recurring maintenance type capex. Think about that. That's exactly the same if you look at free cash flow to the firm, that you're taking out the fixed capital investments. It's a very similar type of approach. Okay, so what does this AFFO mean? It's basically what you've got left to distribute to the investors that's not encumbered by anything that you need to invest in the properties or anything. Okay. NAV, we've kind of gone through that. This kind of cash flow, you guys know what it is. Fine. Okay, let's go through this. If the book value for property is 100 million, book value, that's on your balance sheet. That's an accounting thing. With 70 million market value of debt outstanding and 1 million shares outstanding, what is the net asset value per share if the NOI is 10 million and the cap rate is 5? Okay, so they don't give you. Let's just assume that the NOI is the same as what next year's NOI is going to be. So you're going to take the 10 million divided by the cap rate, you can get the value of the property unencumbered, okay, with no debt or anything. That gives you 200 million. After you've done that, you deduct the liabilities, which is the market value of the liabilities, which is 70. And then after you've done that, you divide it by the number of shares. Then you get answer B. Okay, you guys can go through that. That's not a problem. Okay, now let's go through this because I think this is a more important one. Here we go. Following information is available for REIT XXX. Net operating income, accounting income, depreciation, cash and debtors, debt, non-cash rent. We're going to use non-cash rent if we want to work out the total income. Okay, capital expenditure, shares outstanding, expected dividends. Okay, if we do a dividend discount, I don't know if I'm going to do that. Dividend growth in year 2, dividend growth rate after year 2, cap rate, that's going to be very important, I'm pretty sure. Then the average multiple. So once you've worked out the multiples, then you're just going to multiply it with that. Cost of equity and risk-free rate. Okay, what is the value of the REIT per share using the relative valuation, using the property average price to funds from operation? Okay, so what are they going to ask you? They're asking you here to work out the funds from operation. Okay. So what are we going to do? I don't want to look at the solution too quickly. We're going to work on this formula. That one there. And what does it use? It does not use NOI. It uses accounting earnings. Okay, that's the important part. Depreciation add back, deferred tax we talked about, and all the other stuff. So let's go through that again. You've got 300. Okay, we've got depreciation. That's irrelevant. That's going to be relevant. I'll just put this quickly. That's relevant. That's relevant. That's going to be relevant because you're going to work. No, that's not relevant. Now, cash rent, going to add back. Okay. Say again? AFFO, yeah. But I'm sure they're going to do both. Let's go through the example quickly. So, accounting of 300, you add back depreciation, we get that 420. So you divide by the number of shares, 100,000, and it gives 4.2. And then the average is going to be this multiple here, and you multiply it, and you get the value. So that's 8.4. So that's A. If you want to work out the okay, this is irrelevant. If you want to work out the AFO, you've got the, well, no, they don't ask that, but if you want to work out the AFO, you've got the 2.7 already, and you're just going to do the additional calculation. Did they say the capex? Yeah, so the capex is there, and you've got the non-cash in. So you're going to adjust that, and then you can work out that as well. Okay. That is it for that. Sorry guys, we just need to rush through this quickly. I've got 10 to... this thing is wrong anyway. It's like 5 minutes too fast. Okay, then on the private equity side, there's a variety of ways that you can create value for private equity. Okay, and there's portfolio re-engineering, favorable terms of debt funding, and realigning interest. Okay, so let me just put this quickly. Private equity, there's two segments. There's venture capital and there's leveraged buyouts. The way that you make money through leveraged buyouts, once you buy out a firm, you've got a crap load of debt at a very low interest rate, hopefully. And then what you do is you improve the company by whatever, like improving the plant and making the right hires and stuff. But the more important thing is you take the cash flow from the company and you pay down the debt. So it's called a debt sweep. As you pay down the debt, let's say you paid $1 billion for the company, 900 million in debt, 100 million in equity. Every year you pay down 100 million in debt. If you pay down the 100 million in debt every year for 4 years, if the company hasn't moved, if it's the same cash flow, the same valuation, you've taken your 100 million of equity and you've transformed it into 500 million rand of equity and 500 million of debt. And then if you sell the thing, boom, you make a lot of money because the bank, you only owe the bank now 500 million instead of 900 million. So that's one way through the debt sweeps that you're going to make money. The other way that you're going to make money is that you're going to improve the cash flow, which inherently is going to improve the company because you raise the EBITDA of the company. Okay, if it's 1-to-1 for the accounting and the cash flow. So it's the same multiple that'll be, and the last one is to expand the multiple. So, okay. I'm going to do this very quickly guys because we've got only X amount of time. Here's the assets. Here's the equity plus the debt. Okay, there's a way. There's obviously special purpose vehicles and all this other crap, but I'm not going to go through it. I just want to give it to you. You're buying the entire company. Okay, so let's say the entire company is 1 billion rands. 1 billion. When you buy the company, you buy either all the assets, or what you're doing, you're buying all the equity and whatever side. You're buying the entire company. Okay, so that's the funding side. The way that you fund it is you say, okay, I'm going to put 100 million in equity, and I'm going to put in 900 million from my friendly banker. Okay, so he comes in and gives you 900 million, great, at a great interest rate. Now you're running this thing and you're generating enough cash flow for the thing to use all the cash. After all your capex and everything, you have 100 million left of cash, and you're taking that entire 100 million and you're pushing it into servicing your debt. So you're not paying dividends, you're not buying shares back or anything like that. All that you're doing is you're pushing that into your debt. So year 1, 100 million. Year 2, 100 million. Year 3, 100 million. Year 4, 100 million. So after 4 years, you have 400 million of debt that you extinguished. Okay. Now you go to your friendly private equity secondary market and man there, and you say to him, I want to sell this thing for the same multiple, whatever. Let's say the EBITDA was let's say the EBITDA was 200 million. If it was a billion, it's a 5 times EBITDA. I want to sell it for the same. So EBITDA didn't move. The same. And let's say inflation is also 0 for ease of understanding. Well, you're going to sell this thing to him for a billion. Same price. Now what you do after you sell it, you need to pay it back to the bank. So because obviously there's a whole new structure that the guys, SPVs and stuff. You take that billion. Here's your share, Mr. Banker. Thank you for making me rich. And I take 500 million. 500 million. My investors have got, 500 million from the 100 million. That's a good IRR. That's exactly how private equity works. That's it. They don't just want it through the debt. They also want to do it through increasing. Well, they do it through leveraging the debt. But the main thing they want to do it through debt and improving the company and exiting it at a higher multiple. Because the current owner doesn't know how to do this. Or he doesn't have access to equity, or he doesn't know the friendly banker man. Most of the times, private equity they've got value creating divisions, and they know how to turn stuff around. And that's actually why the current management probably doesn't know how to do this. It's a very specific skill set, guys. It's not that easy. Okay, let's continue on. Okay, so on the private equity side, what's important is that the stuff is very aligned. Okay, so stuff that you need to be aware of is compensation is very much aligned to how the company is doing on both the private equity and the management team. You've got tag along and drag along clauses. So if the company is taken over by someone else, a private equity company, then either the management team and stuff goes along. Non-compete clause, guys are not going to compete, that's self-explanatory. Board representation is massively important for these guys because that's how they control the company. Because that's how they can make sure that the CEO doesn't buy another helicopter or anything like that. That's stupid. They want to make sure that they use the cash for the right reasons. Once again, required approval, that's self-explanatory. Claims priority is interesting because depending on where you rank on the waterfall, you can either, if let's say you can only exit the value of the company at a certain point, then obviously first you get this guy makes his money, then this guy gets his money, then this guy's making his money. So in other words, first the debt guys will get, that's a claim, the priority claim. First the debt guys will get their money, then the preference share guys, and then the equity guys. And maybe in equity there's also a bit of a split when it comes to that. That's normal for any capital structure. The debt guys, depending on how high they rank, they get the money, then the junior debt, then the preference shares, and then the equity. That tends to be the ranking. And then earnouts. I'm sure you've seen it a lot of times when Spur decides and they buy a company, the management stays in place, and what tends to happen is they say, okay, if in year 3 the EBITDA is this, and it's above this number, we will give you an extra whatever % above that as a multiple. Okay. Various characteristics, buyout and venture capital, you guys can read through this. I think that's self-explanatory. The 3 things I want to highlight: leverage, massive when it comes to LBOs, very, very little when it comes to VC, because VC is an equity funded type of, well, they might call it like preference shares or debentures or whatever, but it's essentially equity type of risk that they're taking because it's a proof of concept most of the time. And the other thing is the cash. Where's the cash flows? Cash flows, there on top. Cash flow is very unpredictable with VC. It's very stable with an LBO. So the probability that the VC can fail is very high, whereas the probability that the LBO will fail is very low. Edcon was an LBO that failed. I mean, that's a very good example of an LBO that was complete disaster. Okay, you guys can go through this. And then the last thing, maybe from a revenue, carried interest for VCs, whereas for an LBO buyout company, carried interest, transaction fees, and monitoring fees. That's all the stuff that you're basically going to be able to get as a private equity company. Okay, you guys can go through that. That's fine. Then the valuation issues and techniques, DCFs. We all know how that works, and that's fine. Relative value and market approach. What's that? That's your multiples. Also very easy. Real option analysis. Just know that it's seriously complicated, but just know about that because that's a whole different thing on itself. The best one I can think about is, let's say you've got a movie that you've made. If you've got the option to make the follow-up or the whatever, then that's either got value or not, depending on the success of the first movie. Okay, so that's the which is one example I can give to you guys. Replacement cost, we've gone through that now from the real estate, and then VC method and leverage buyout method. We're going to go through a VC method in the next few seconds, so it should be fine. Okay, and then other considerations, you guys can go through that. Price multiples, you know, DCFs, you know, and then the various types of LBOs. You have a normal takeover, so you just take over the entire company. You have management buyout. So takeover is like when Anheuser-Busch bought SAB, that's a takeover. Management buyouts, the company itself, the management, this is where you basically, what you just mentioned, why doesn't the management do it itself? Sometimes they do. So maybe it's a listed company, the market doesn't give it a fair multiple, very, very cash generative, the guys know they've got a great business. Then what might happen is the company says, listen, this thing's trading at, the management say, this company's trading like a 3 times P ratio, it's very stable cash flows, let's just buy the thing out, there's no benefit of being in the public, and let's leverage this thing out. That's an example of a management buyout. And leverage buyout the same, but it's external guys, not the management team necessarily. You guys can go through that, that's fine. We've done that basically. Okay, the main inputs in the model of an LBO model, the cash flows, because that's very important. The expected return on the providers of capital, so that's obviously your debt guys and your equity guys, and your equity guys are going to be a variety of guys. So it's going to be the pref shares, maybe there's some mezz debt in there as well. And then total financing required. And depending on how you change that variable, it's going to determine how much the guy's going to make at the end. It's also more risky, but what tends to happen is if you finance a lot from the bank, and the bank takes most of the risk, then your small equity sliver is going to make a crap load of money if this thing succeeds. Okay. Exit values we kind of said already, so that's paying down debt, the multiple, increase in multiple, increase in earnings or EBITDA usually, and then the debt reduction. The debt reduction is the one I used about debt sweep now. Then on the valuation of VCs, venture capital, you have pre and post money valuation. Pre-money valuation is, so let's say a company has got 3 financing rounds, well, let's just say 1 because that's going to be easier. 1 financing round they want to do now. They think they're going to exit this thing in 5 years' time at a certain price, and you've put a massive discount rate to that thing. If that's what they're going to exit it at, you're going to discount it back to today when the guys want the funding, and that's the post-money valuation. If they need 2 million rands or 5 million rands or whatever it is, then you take that post-money valuation, you deduct what you're going to put in, and that's a pre-money valuation. It's literally as easy as that. So post is equal to pre plus investment. I mean, that's like super easy. And then if you want to work out how much the fraction that you're going to get, it's going to be the investment divided by the post-money valuation. Okay, we're going to go through a very quick example now. So appropriate methods, discounted cash flow, relative value, or replacement cost, real option. Guys, you're probably just going to do one of these 2 in the exam anyway. So example, venture capital firm invests $2 million on a $5 million pre-money valuation. What is the proportional ownership? Pre-money 5, post-money 5 plus 2, 7. Easy as that. 2 divided by 7, that's your proportion. Okay. Everybody with me on that? That's like basic arithmetic, so you guys are good on that. Okay. Advantages, disadvantages, you guys can go through this. This is the various exit stuff. You always want to do an IPO if you can, because you're going to get the most money out of it. Secondary sale, you sell to someone else. MBO might also be a nice one if the management wants to buy that. Liquidation is the worst one. One that's quite nice as well, it's not the one that you want to go for, but another option that you have is called recapitalization. And what that means is that they've paid down all the debt now to 500 million in the example I had before, and now you say, you know what, I want a nice juicy dividend, let's just lever this thing up again to 900 million debt, and you take the 400 million, you pay yourself a dividend for that. That's another way that the guys get money out of it. And then lastly, the timing of the exit is important, because if the market is high, then guys will come to the market and try to IPO as soon as possible, and that's why Lyft and Uber IPO'd now, because the market is high, it's the right time. In 2 years' time, it's probably not going to be the best time for those guys to IPO. Because probably the market's going to be down, and it's not going to be as, because the market goes through cycles, as you know. Okay, LPs and GPs. Your LPs are your investors. Your GP is the person that manages the fund. Okay, that's as simple as that. LP is limited partner, limited liability. Think about it from that perspective. So that'll be your pension funds and so on. Your GP will either be in the private equity space or be the guy that runs the private equity funds. Okay. And the life cycle is the first 2 years you try and raise raise funds. The funds are called committed capital, whereas it's called committed capital, whereas if you're a hedge fund, it's called AUM. Okay, it's basically the same thing. The only difference is AUM in a hedge fund is already in the hedge fund, whereas committed capital for a private equity fund, the guys just signed a deal saying, we will commit so much capital to you, and once you do a call down or draw down, we will pay you the cash over in whatever time period that the docs specify. Then year 3 to 10, okay, this is quite a long timeline, but it depends on what type of fund it is. After you've done the raise and you've closed the fund at whatever $1 billion committed capital, then you go out and you start to look for ideas. You probably have a few ideas, but you go and you deploy the capital. As you get opportunities, you draw down the capital from the guys. And then after a certain time, then you either going to try and exit if the market is ripe for an exit, or what you're going to do is you're going to extend it because you don't want to exit now, it's a bad time. Okay, so it's one of the two that might happen. So if you had just to as an example, if you're a private equity fund, if you're an LBO fund and your vintage, I think we actually have that soon. Oh, your vintage. The vintage is the year that you began. If your vintage was 2005, 2006, and you're an LBO fund, you're going to have a disastrous return because it was at the wrong time that you launched that fund. Because 2008 happened, global financial crisis, you overpaid for everything. Okay, that's the tendency of these things. So if you started your LBO in 2009, 2010, which would have been very difficult because the market was not dishing out capital like candy, then you're going to have a phenomenal track record. Okay, that's even if it's just a cycle, just how things work. Okay. They've got many funds, yeah, many funds. Yeah, because it's served it's just so when you look at it's a good question. So if you look at a private equity fund, it's let's call Carlyle or KKR or 3i or whatever you want to call it. All these listed, a bunch of them are listed. They have like departments of this department does infrastructure, and there's like a variety of funds, whether it's European focused, American focused, and they have I don't know how many different funds. So you probably I haven't looked at that, but they will have hundreds of funds. Okay. So they'll close the fund because the fund has come to a close because it's like it served its purpose, it's exited the investment. It's not a perpetual fund, if I can say. The private equity firm is perpetual, if things go according to plan. But the fund itself is like ring fence. So that's the specific fund, yeah. So when I say fund, guys, I mean, okay, you have the private equity firm, and in the firm there's fund 1, fund 2, fund 3, fund 4, like there's a bunch of funds. That's basically how so that's how it works. Management fees. I'm not going to get to the last reading before the break. I just want to mention that, so don't worry about that. So in terms of the PE fund, management fees, that you're gonna either take that from the committed capital or the drawn down capital. The tendency is a lot of times it's from the drawn down capital. Then, or the net asset value, so as it grows. Then you have transaction fees. As you do these transactions and do due diligence stuff, you also get paid that. Carried interest is the performance fee. That's a performance fee element, and it depends on how the materials or the documents are written. Okay. Then your ratchet will detail the allocation of shares between the management team and the shareholders. Okay. Why is that important? If they do phenomenally well, and they've taken this thing into sky-high multiples and stuff, then they would tend to have a higher percentage of the fund of the company itself, which is quite nice. So it's a very good goal or very good alignment, because what tends to happen is if the ratchet kicks in, the investor made a lot more money. Okay. Hurdle rate, the minimum you get hard and soft. Usually with these type of funds you have a hard hurdle. A hard hurdle means you can only charge performance fee above that hurdle rate. A soft hurdle means anything below. If you're over the hurdle, then you take everything from that percentage down until the previous high water mark. Okay, we're going to go through that in No, we're not going to go through that. So I'll do that after the thing. Okay. Fund size, how big it is, vintage when it started, and term, how long they think it's going to be. And then you have a variety of other stuff. Keyman clause, that's the important guy to be. That person has to be there. If he's not there, then certain things get into place. And then performance disclosure and confidentiality. I think that's self-explanatory. Clawback. It's build carried interest, and then you think foul. Then obviously the investors can claw back some of the carried interest that was paid. Waterfall's got to do with who gets the money first. Is it first the GP? Is it first the LP? What tends to happen is the LP tends to get the money first, and then after that, the GP tends to get it. Important thing about this is that it can either be done by a deal-by-deal basis or a total return basis. Now, this is where it's important for you as either the investor or the fund manager. If you're the investor, what you want it on a total return basis. Because the funds that do really crap, you want that to influence the funds that do very well, and you've got like an average. Whereas if you're the manager, you want it on a deal-by-deal basis, because if you have one fund that does crap, it doesn't impact your bonus on the one that does well. So that's a natural conflict of interest that you need to be aware of. Tag along, guys, you can read through this. No divorce clause. That's just they agree that okay, go away. Removal clause, don't like the guy, chases him away. Investment restriction, only certain sectors or limits, or you can't spend 100% of your fund on, or more than 50% of your committed capital on one investment, or maybe even one sector. And co-investment, you allow other LPs to come, and that's quite nice if you want to de-risk the investment. Net asset value, you guys know what that is, and due diligence, need to do one. I don't know how to say anything else. You guys can read through this. Yeah. Another word for that is investor. Okay. And then the various type of multiples and return metrics and so on. So gross IRR, that's before management fee, net IRR after, and then you have various multiples. Guys, the multiples of private equity are very, very different to the multiples that we use for equity. Just going through it quickly, paid in capital, so that's how much capital has been drawn down into the fund. Distributed to paid in capital, so that's how much you paid back to the investor divided by the paid in capital. Remember, the paid in capital doesn't change when you pay it back. The paid in capital, as you drew it down, it accumulated, it went up to a point where you either drew 90 or 100% of the committed capital. So that's a PIC. The distributed to PIC, that's how much you paid back to the investor. Okay, that's actual. The residual value to paid in capital, that's what's left in the fund. So the total return, which is the last one, total value to paid in capital, that's what you paid back to the guys, the LPs, and what's left in the fund, the value, those two added together divided by the paid in capital, so how much capital was provided to that fund. Okay. Quantitative, guys, you can read through that. Benchmarks, there's a variety of stuff. Like you can, most of the time it's a hard hurdle, so it'll be an absolute hurdle. Okay. Then this example is very long. I want to go through this example, but we're not going to have time now. We'll go through that after the break, I think. And then the venture cap, guys, I really want to go through the example. The example's quite long, so we can go through it either at the beginning of the next break or beginning of the next session, or we can do it at the end of the day. We can check. Okay, the VC method, we've gone through that, the pre and post money, and the way that you do it is you're going to say MPV. RR method, there's a variety of stuff. The main thing is that what you're going to do, you're going to get the exit value after a certain amount of years, whether it's 30 million, 50 million, whatever. You're going to use this massive discount rate, and you're going to discount it back to a certain point. That's going to be your post-money valuation for that round. Deduct how much is going to be invested in that round, and it'll give you the pre-money valuation. And it can have various rounds. Okay, so that's quite important. How much you've got, you guys can read through this. I don't know, is this a difficult section? Do you guys want to go through this in more detail, or is okay? You guys basically know what it is. Okay, and that's the new shares and issue. Okay, this is an example. It's exactly what I said, 5 years out, etc. You know what it's going to be. 20 million, 5 years time. They require 2 million. So you're going to value that back by the whatever this percentage is, 40%. So 20 million divided by 1.4 to the power of 5. Discount that back, it'll give you a value, and you take that value minus the 2 million, and it'll give you the pre-money valuation. So that was the value you got for the 20 million divided by 1.4 to the power of 5. And then I think this is the last one. Then the last thing what you need to do as well is the way you adjust the discount rate is by taking into account the probability of failure. And that's very important. So in most cases, entrepreneurs present overly optimistic projections. And one way that you can do this is that you can adjust the discount rate by taking into account the probability of failure. Okay, so if your probability of failure is very high, like 50%, which it might be 80% in some VC funds, then you're going to say, let's say the normal required rate of return for equity investment is 10%, then 1 plus 1 divided by, if it's 80%, 0.2, and it'll just shoot up that discount rate that you need to use for that. So that kind of takes into account the probability that this thing is going to fail. And then terminal value estimates, you need to use that probability of failure in it because you want to make sure that you are conservative as you possibly can. Okay, guys, that's for now. We're going to go through that private equity example on how the distributor pick and so on later, but that's a very important one because I think they might ask that in the exam.